Opening bell happening now, and we are in the green for the S&P. After a record-breaking rally on Wall Street, despite hotter CPI, despite 0.4 for a consecutive month, even so, we are seeing a turnaround on the NASDAQ 100, weighed down by Tesla after a rare downgrade from Wells Fargo. The EV story, they are not convinced that price cuts will help. Russell 2000 futures also on the back foot after underperforming yesterday. When it comes to the rest of this market, bonds are also under pressure, higher by 2.5 basis points for your 10-year yield. We were just speaking to BMO, who said be cautious of buying duration ahead of election risk. Meanwhile, euro strengthens just barely. We're at 109 versus the dollar. NYMEX crude up 2.33%. We had a report of shrinking U.S. stockpiles, and they celebrate at the bell, and they celebrate in these crude markets. All right, one stock to watch at the open. It is Intel, the Pentagon pulling out of a plan to spend as much as $2.5 billion on a grant to the chip maker. Abigail Doolittle has more. Abby?
Well, Danny, we did break this news, of course, after the close yesterday. Investors not liking it with that stock down more than 1%. And the idea behind this grant, so as you mentioned, the Pentagon was slated to give Intel $2.5 billion out of $3.5 billion to fulfill some of the 2022 CHIPS Act to make them a dedicated supplier for processors to be used in both military and intelligence applications. Well, with the Pentagon pulling out, that means that the other provider of funds, the Commerce Department, U.S. Commerce Department, that they could be on hook. Initially, they were only supposed to give $1 billion, but maybe now some are saying that they would give that full amount. But does that make sense? There could, of course, be contention around that. I think that the uncertainty around whether or not that $3.5 billion, where will it come from? Will it come from the U.S. Commerce Department? Does have this stock under some pressure. Also interesting is the idea that Intel CEO Pat Gelsinger just last month said that the company would be receiving an award from the U.S. government very soon. He didn't provide an exact timeline, but with this news, it kind of goes in the face of that. And relative to that CHIPS Act, it is, of course, to help the U.S. become a little bit more dominant in the chip space. Taiwan right now is the leader for global chips production. Intel, again, under pressure on this news that the Pentagon has pulled out of that $2.5 billion worth of funding.
Abby, appreciate it. All right, let's turn now to earnings. Petco reporting comparable sales for the fourth quarter that topped estimates, along with a new change at the top. Katie Greifeld has more. Hey, Katie.
Hey, Danny. Petco, ticker WOOF, I will note. It's on the move higher today after that update. Let's start with the numbers. Fourth quarter adjusted EPS, you take a look at what we saw there. That came in at 2 cents, right on the money. The estimate was for 2 cents. Fourth quarter net sales a little bit higher than expected at $1.7 billion. It was the fourth quarter comp sales beat that analysts are pointing to as one of the reasons why you're seeing this move higher. Fourth quarter comp sales, they actually did fall about 0.9%. The estimate, though, had been for over a 2% decline, so a bit of good news there. Also, the CEO change, like you mentioned, drawing some eyeballs today. Petco said that Ron Collin, I hope I'm saying his name right, he stepped down as CEO and chairman, and a member of the board, R. Michael Mohan, he has been appointed interim CEO. I will point out that he has been on the Petco board since March 2021. He was previously the president and COO of Best Buy. And Bloomberg Intelligence coming out with a note saying that this maybe isn't as unexpected as you might think. You think about the underperforming quarters that Petco has put up and also what they call rather desperate strategies that put into question the direction of the company. Makes sense that they're seeing a little bit of a shuffle here. I will note that even though you do see Petco up almost 6% today, it went public in January 2021 at $18 a share, currently trading below $3 now.
Katie Greifeld with the latest on WOOF. Thank you for that. From pets to chips, shares of NVIDIA are paring their pre-market gains. They're trading lower despite a big boost, I should say, from Bank of America. They now have risen their price target to $1,100, calling their upcoming event AI Woodstock. Ed Ludlow joins us now. I mean, AI Woodstock, really, Ed?
I'm hoping so, because I'm going. GTC conference, GPU tech conference, and it's actually critically important. It's interesting, the stock's down almost 2%. It jumped 7.2% on Tuesday. We could say at least there is some positioning going on ahead of GTC, right? There is going to be substantive information given there. It's a developers conference. You know, it's probably historically most analogous with Google I/O or Apple WWDC. But in this case, what what the street is bracing for is a product roadmap, the next big thing. And for NVIDIA, that's probably the B100. That would be B100, not H100, B100. And that will be probably their first multi-die chip. And multi-die chips are important because what they do is basically take a large form factor and partition it into smaller form factors. That improves power efficiency. And basically the B100 is likely to have double the performance of the H100. And the excitement around that is that if NVIDIA can tell investors, here's our latest GPU, here's how it fits into what's happening with AI, here's how quickly we can get it into production and ramp, then there'll be evidence that they can basically hold on to this competitive moat in building AI accelerators that are being used all over the world right now in the hyperscale data center context. But it is a developers conference, and I think a lot of people forget that NVIDIA's done a lot of work itself in software. Software not just in the AI context, but they're also building their own large language models. So my understanding, about 300,000 people attend GTC, both virtually and in person. This will be the biggest in-person GTC ever, but also a kind of return after the pandemic era and post-pandemic period. And one of those 300,000 will be me, and we'll do some good reporting on the ground. The stock down 2%, but as I say, that's probably a pullback from a big jump on Tuesday.
Ed, appreciate it. Yeah, Amy Wu Silverman saying that March 18th conference could be a clearing event for the entirety of the market if it disappoints. Okay, let's turn back to earnings now. Dollar Tree is falling short on both its profit and its annual sales outlook, as well as closing about 600 stores. Simone Foxman has more. Simone.
Yeah, Danny, shoppers are supposed to be looking for bargains, but Dollar Tree watching its shares fall at the moment the most since August after some pretty subpar results here. For the first quarter, it's looking for earnings per share of $1.33 to $1.48. The street had anticipated $1.71, and its fourth quarter was a little bit light as well, even though it saw revenue rise 12% on a year-on-year basis. It saw same-store sales rise 3%, but at Family Dollar, that was not the case. Same-store sales were down 1.2%. The company saying on its earnings call this morning that persistent inflation and reduced government benefits continue to pressure that lower-end consumer that comprise a sizable portion of Family Dollar customer base. You mentioned maybe this is part of why it's deciding to close some 600 Family Dollar stores in the first half of fiscal 24. That will be added to by another 400 Family Dollar and Dollar Tree stores as their leases expire this year. Note that it operates about 16,700 stores, also mentioning shrink as a headwind in the first half. Bloomberg Intelligence says closing these stores is a needed move, though the $2 billion in impairments that it's notched suggests that closing stores does not always work, and the right formula, Bloomberg Intelligence says, remains elusive. But shares falling for Dollar Tree this morning and bringing down the shares of Dollar General, Five Below, other discount retailers as well, Danny.
Simone, thank you very much. Simone Foxman there. All right, the overall market is little changed this morning, with tech stocks weaker after another session of all-time highs for Wall Street yesterday. Linda Dissel of Federated Hermes remains cautious on this market, writing, though the U.S. has been on a roll, in some sense, it's the dirtiest clean shirt in the laundry. Japan is up 20% on the year. European stocks up 9% versus the S&P's 7% gain. How long can this keep going? Linda joins us now. Linda, I love this because usually we say it's the cleanest shirt in the laundry. I had to double check this because I couldn't believe that Europe has actually outperformed. So let me ask the question you did. How long can this keep going?
Well, thank you so much for having me this morning. To be clear, we have been bullish at Federated Hermes. We just thought we'd finish the year at S&P 5200, and we're almost there as we speak. So it's been quite a momentum market, and that's what we mean by how long can this keep going on. This is a momentum market in the United States more than you have anywhere else in the rest of the world. That's leaving a lot of other stocks, particularly value stocks, behind. And so if I remember, it's an election year. You usually make all your money in the back end of the year after the election uncertainty is over. We have been tracking normally here for the first part of the year versus history, but it tends to get sloppy in the middle of the year. So we're saying it'll probably be a volatile year, but so what? Because we still think you can get the 5,200 by year end, and we may have to revisit that to the upside.
I love that. It's volatile, so what? A good reason to remain steadfast in the face of that volatility. Linda, in terms of this being a momentum market, every estimate is different as to what the trend followers are due. Goldman, for their part, thinks CTAs have been running, or UBS rather, have been running a very hefty long in this market. Part of the reason we continue to see upside, but they say if the S&P drops a significant amount, which they're saying is about 5%, you could get selling to the tune of $80 billion from those trend following CTAs. Are you concerned about the momentum nature of this market, that it can reverse quite violently and suddenly when it does?
Well, I think they're right about that. When you ask me if I'm concerned, we're saying it'll be volatile, but so what? And we want to really emphasize that because the fundamentals of our country and earnings are good, and we think that we can finish this year positively. But when a third of the market is just a handful of stocks, and stocks that pretty much everybody owns, and stocks that are right in the middle of the momentum trade, if something goes wrong, and I think that NVIDIA, which I'm not commenting on any names at all, but NVIDIA, which is a well-known household name, traded within a 10% range on Friday. That's a lot of nervous holders who may dump and give us a really nice correction, which is just what the doctor ordered, actually.
The irony, though, of this year, Linda, is if you're an active manager, the way that you beat the benchmark was loading up on NVIDIA, on those types of names. If they can be the catalyst for a correction, if you still want to outperform the market, do you need to do what you're saying and look elsewhere? Or is it still the case, if I want to do well, I got to own these AI names which are outperforming, because so far this year, again, that's the only way I've been able to do it.
Yes, and what I'd like to emphasize is that, and I was there for when the internet bubble burst, this stock market is nowhere near as expensive, nor as the leaders anywhere near as expensive as they were then, which means that if we get a pullback, we probably won't get the kind of crash that you saw then, but what you will find is that these names, which are excellent companies, their customers are rich themselves and can spend lots and lots of money, and AI is for real good. That's a market that continues, names that continue to do well. But if you believe all this, you can believe that breadth really will happen, and we can find better returns on a percentage basis by looking outside of just a handful of names. We've been doing it in technology so far this year, and we've been doing it in some early cyclicals, but you can imagine that the market can expand even beyond that.
As one trader told me, the thing that people do is they wake up, they don't check the market, they just check NVIDIA. So it's a hard habit to break out of. But Linda, you write that it was not rate hikes that killed the tech boom of the 90s. Rather, it was weakening economic growth and tech spending outlooks that did it in. And at the moment, we remain on trend for tech spending. Linda, I think that's such important historical context, because we've been freaking out about higher rates, and then we stopped freaking out, and then we freaked out that we weren't freaking out about it. But it is that weakening economic picture and weakening tech spending, which did in the bubble. Is that at risk of playing out again?
That's the thing about human nature. We seem to like to freak out, and that's what gives us buying opportunities. So if we acknowledge that it was the economy that was weakening, and we say, okay, even around the globe, they're having to raise estimates for global GDP this year. The U.S. has been in a booming situation. We remain a very strong country, an extremely resilient consumer. And we talk about the dollar stores, and we talk about the lower income cohort, which is having trouble. We'll get some news this week on Thursday from retail sales, but the vast majority of the United States population is good. And if you look at the people in the prime age working arena, age 25 to 54, they have just a low 3.3% unemployment rate for the last 3 months. This is a consumer that's got a job, that's got money, that has lots of money to spend, spent it in a lot of places, and maybe want to spend some more in the markets.
Yep, certainly, especially if, I don't know, if you hold Bitcoin right now and it's at a record high, maybe that's something else you can put to work. Linda, we started out by mentioning that of the outperformance of Europe. The DAX also hit an all-time high yesterday, along with everything else. Just quickly here, Linda, only about less than a minute, but can you keep buying Europe given the economic issues it has?
We have slight overweights at Federated Hermes on international. That includes both developed markets and Europe. And as you're suggesting, there are a lot of cross currents. They're in trouble. Germany's the strongest sister over in Europe, and they are in an economic recession now. And yet they make new highs in the market. It's a relative game as versus as versus the earnings estimates. And inflation comes down very dramatically around the globe, mostly EM, but also Europe, and better than here in the United States. That's the reason why we're overweight Europe, if only slightly so.
Linda, really appreciate your time this morning. That's Linda Dissel of Federated Hermes. And again, this year might be volatile, but so what? Love that from Linda. Okay, coming up, TikTok's ready for a legal fight as the House votes on a crackdown.
We're not there to ban it. I've said we want to make it tic-tac-toe. We want to make it something that is not a fearful social media platform, but one that is very positive.
We'll have the latest on TikTok's fate next. This is Bloomberg.
This plainly is a conduct law, meaning we're acting because of the demonstrated malign national security threat of TikTok, not because of the content of anybody's speech. And the bill is narrowly tailored, which is key for First Amendment analysis, because it simply requires divestment, meaning the millions of Americans that love TikTok, I'm not one of them, but they can continue to use the application, but just in a more secure way.
I guess the commissioner doesn't have his own TikTok account. That was Republican FCC Commissioner Brendan Carr speaking earlier on Bloomberg. The House votes on the bill at the top of an hour that would force TikTok's Chinese parent company to sell it or face a ban in the U.S. Sources say TikTok is planning a full legal fight if the bill becomes law. So on Vote Watch, joining us is Anne-Marie Hordern and Ed Ludlow. Anne-Marie, what do we know about how people are likely to vote on this so far?
I'm on Vote Watch. Ed is on Buy Watch. Look, when it comes to this vote, it's likely going to sail through the House, as it did that committee that was a bipartisan support of 50-0. So those committee members want to see it hit the floor. It's coming under this rule suspension, so it needs to get 2/3 of a majority for it to go through. Steve Scalise, number 2, the House Republican leadership team, says that this is going to pass. When you talk about who some of these individuals that might vote against it, you could see individuals that are concerned with free speech. We see that from a number of Republicans, but also progressive Democrats. Also many of them who are concerned about the fact that this is a way to reach youth voters. We can't forget, the Biden campaign is using this to campaign on, although TikTok is banned from use on government phones in the White House. Someone like Alexandria Ocasio-Cortez, a progressive Democrat from New York, already tweeted, Danny, that she's a no when it comes to this vote.
Yeah, the irony there is definitely not missed on many people. Ed, this isn't exactly the first time that TikTok's had this threat. Perhaps it's the first time it feels real. But what has TikTok already done to prepare, and what can they do to prepare for the inevitable outcome of this?
We'll go back to the reporting. So sources say that TikTok will wage a legal battle to prevent or at least make a sale of itself or its U.S. operations the avenue of last resort. Go back to China's position on this. And China has also said through its own channels that it would block any such deal. And, you know, we're proceeding on the basis that it's a foregone conclusion, right? Because the House is likely to vote in favor of the bill. If there are reservations in the Senate, their bigger picture about the powers this would extend to the administration in terms of oversight and censorship. But I say all of that because the list of potential buyers would be small anyway, right? Think about the antitrust action this administration's taken against the biggest tech companies, Apple, Meta, Microsoft. Would they be allowed to buy it? Bobby Kotick, the former Activision CEO, there was a report in the last 7 days. He was putting together a bid to potentially buy TikTok's US operations. Rumble, the conservative social media platform backed by Peter Thiel, the stock jumped 18% yesterday on reports that it is considering a bid for US operations. How much are those US operations worth, right? ByteDance, the parent company of TikTok, is valued at around 240 billion US dollars. Well, how do you take a chunk of that, and how would they let it proceed? I think there's a lot further to run on this, and we remind ourselves that 170 million Americans use TikTok, and some of them quite like using it.
I think that's an understatement. I think maybe addicted is more an accurate answer. I mean, I like TikTok, so, you know, my full bias is apparent. Anne-Marie, Ed, thank you so much. And the House floor is gathering, getting ready for this vote. Again, it's expected to happen in about 7 minutes time, but as Anne-Marie so wisely mentioned to me during the break, this is Congress, so it might not happen at 10 a.m. on the dot. Okay, let's get to some of the sector price action this morning, and let's get over to Bloomberg's Abigail Doolittle. Abby, what you looking at?
Lots of A's here, Danny. As for the sector action, we are looking at a small decline for the S&P 500, but interestingly, most sectors are higher, led by energy up up about 1.75%. This with oil up more than 2%. Utilities higher despite the fact that yields are up. That should make those dividends look less attractive, but investors today seeking a little safety. To the downside, it's all about technology, down 1.1% as NVIDIA is down sharply. Its worst day in a few days, a rare break for the stock that has just been rallying on that AI craze. But one really unusual pocket of strength, Danny, because of course Chinese equities have been underperforming U.S. equities for a few years now. But take a look at the Golden Dragon China Index, up about 8% over the last 4 days. I think this is technical trading because you have this index over this time period pop above not just its 50 and its 100-day moving average, but today it's 200-day moving average. So let's see whether or not these gains can hold.
Yeah, China stocks in a technical bull market, but again, how long does that last? Abigail, thank you very much. Okay, coming up, it's the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. 56 past, about 30 minutes into your trading day. We got outperformance of Russell, underperformance from NASDAQ 100, down 0.6%. Okay, let's set you up for the day and for the week. It is your trading diary. The House is expected to vote on that TikTok bill at the top of the hour, so just a few minutes time. The Treasury selling $22 billion in 30-year bonds at 1 p.m. Eastern. And President Biden will be discussing the U.S. economy from Wisconsin at 5 p.m. Then you get more data, U.S. PPI, retail sales, and another round of jobless claims on Thursday. And then finally, on Friday, we round out the week with the UMich Sentiment Survey. This was the countdown to the open. Stocks head lower. This is Bloomberg.
Minutes into the U.S. trading day on this Wednesday, March 13th. Here are the top stories we're following. The TikTok on TikTok. U.S. lawmakers preparing to vote on a measure that would force Chinese company ByteDance to sell TikTok or face a ban in the U.S. We'll bring you the latest. Hovering near all-time highs in the stock market with the bulk of earnings behind us and the Fed meeting ahead of us. Where to next? We'll discuss. And grocery aisle M&A. Scott Moses of Solomon Partners joins to talk through the proposed Kroger-Albertsons merger and Walmart's growing dominance in grocery. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets this morning and near all-time highs, but a little bit lower today. If you take a look at the S&P 500, slightly in the red here, down by about 0.2%. Of course, still well above 5,100. But you take a look at the Nasdaq 100, losses getting a little more serious, down about 0.8%. Of course, that follows a big up day yesterday, so make of that what you will. And you can see, of course, volatility rising a little bit. The VIX still below 14, but inching higher and higher. But let's get to what's happening this hour, and that is the House voting on a bill that would force TikTok's Chinese parent to sell it or face a ban in the U.S. Now, sources say that TikTok is planning a full legal fight if the bill becomes law. Bloomberg tech reporter Jackie Davalos joins me now from Washington. And Jackie, how are we expecting this vote to actually go when we get there?
It's a really tense day here in Washington. And as you know, Katie, the House or the Senate haven't really found common ground to agree on almost anything except this bill. It's a bipartisan effort that was brought forth by the House Republican chair of the Select Committee on China, Mike Gallagher of Wisconsin, but it's gotten massive support from top Democrats as well. So it's largely expected to pass the House, but it faces an uncertain future in the Senate, where some lawmakers there have said they want to hold more hearings around what this could mean and the potential impact of a ban if the company decides not to divest.
And Jackie, let's get to the heart of the matter and why the U.S. is potentially looking at a ban here. Of course, this comes back to national security concerns that TikTok poses. What evidence is there to support that view?
Well, Washington has maintained that the underlying algorithm that powers this addictive nature to TikTok, keeps us scrolling, is actually being controlled by China, which has access and really purview over ByteDance, TikTok's parent owner. Now, TikTok has said that there is a wall between user data and that control. However, as we've seen, lawmakers are not really convinced. Even just a few months ago, when the CEO, Shou Chew, came on to talk about online child exploitation alongside with some tech leaders, the focus for him there was really this relationship to China. So even though they have maintained that this national security threat, there's nothing to see here, there's not much to hold there, lawmakers aren't convinced. And this is just kind of a continuation of the scrutiny that the company has attracted. Even when former President Donald Trump was in office, if you remember in 2020, that summer leading up to that election, Trump actually proposed a similar movement, to an executive order actually, to have the company divest or see a ban. So this isn't new. This effort has kind of been gathering steam, and here we are today with a vote that is looking ever likely in the House.
Well, Jackie, stay close, of course, as that vote gets underway. That is Bloomberg's Jackie Davalos in Washington. Thank you. Let's broaden out now and take a look at these markets, because joining us now, I'm pleased to say, we have Mark Spellman. He is Alpine Saxon Woods CEO, sitting on set with me. Mark, great to have you in person here.
Thank you. Good morning.
I want to start with the first line in your notes, and that is that tech stocks are currently still in a melt-up. What does a melt-up mean to you?
Take a look at the chart for NVIDIA. I think that's the textbook right now. Well, the last couple of days, you have a stock that's up basically 100%. In the last couple of days, it's up about $150. Terrific stock. There's no doubting it. They generate a lot of cash flow. They're doing this all with the cutting edge technology. It's a name you want to own. We just don't think here at $900 it's a great buying opportunity. We look for a pullback. There's a number of names that we look for a pullback for.
Interesting. So it's not a sell, it's not a buy, it's a hold.
If you own it, I'd hold it. If you haven't bought it yet, I'd wait.
Well, let's talk about the fundamentals a bit. The fact that it is a hold, it's not a sell. It's been interesting watching sort of the sell side try to wrestle with the valuations at this point. And you've had Goldman, you've had JP Morgan coming out and saying, if you take a look at earnings, they do justify what you're seeing in the stock. I mean, how are you squaring that circle?
We agree with that, basically 100%. I was doing this in 99 and 2000. There's a big difference. AI is profitable. These are real companies making real money, and the valuation on NVIDIA is not outrageous at this point, but we do get these melt-up bubbles where people can't get enough of it. So, there's other names in the group. Like, for instance, I mentioned Google. Google is a name that has been kind of get hit on the AI story because the worry is search is going to get hit. I mean, Google, more than half of their sales and profit come from search and ads sold on search. And they could be hit with AI going forward. However, their AI offering, Gemini, has kind of stumbled a little bit, but we think they're going to get it together. They have terrific engineers. They have access to the greatest data of any company on earth. We think they'll get it right. And the valuation right now at 15 times free cash flow with 10 to 15% top line growth, you can't find that attractiveness much else in the group. You compare that to Apple, 20 times cash flow and 2 to 3% top line growth. So we're thinking Google actually, for new money right now, that's where we would go rather than in NVIDIA.
And Mark, it's a great point that, of course, AI, it's causing some crazy stock pops, but also to the downside, creating those gaps slower as well. But you combined two buzzwords there, so melt up and bubble. So you think that we're still in a melt up. Are we in a bubble?
I don't think so, because again, the basis of what we do at Alpine Sachs Woods revolves around free cash flow. Companies are making a lot of money right now. They're generating lots of free cash. They have lots of options to do things with that money. They can buy stock back, which is something we like to see. They can increase their dividend. They can make an acquisition. That's a healthy atmosphere. It's just a matter of what you pay for it. So we're not bearish by any means. We're just looking for good opportunities and trying to discern against names we want to buy now versus later.
And so we're talking about big tech, and of course it seems like that's all we've been talking about for the past couple years at this point. Let's venture outside, though, of that sector. You take a look at mid caps, you take a look at small caps. Small caps in particular, I know they had quite a run to end 2023, but it feels like they just can't get off their feet. How are you thinking about small caps?
We're very encouraged by the recent move in small caps. Even if with the recent move, if you compare the NASDAQ 100 to the Russell 2000 over the last 3 years, the QQQs have outperformed by 50 percentage points. I mean, that's a massive thing. In and of itself doesn't mean you buy small caps, but the recent broadening out of the market, I like to call it, this is the year of the magnificent 493, and we're optimistic that things are going to broaden out.
That would be magnificent rather, if it were to happen. Tell me about the potential for M&A and how that plays into that magnificent year that could happen.
Yeah, I think you're seeing that a lot. There's a whole lot of dry powder out there. The difference, I think, this time is the private credit world, and the private world is much bigger than it has been in the past. So that might hold back like public equity kind of M&A, but we are optimistic that M&A is going to continue to pick up this year.
All right, Mark, stick with us. We have a lot more to get to. That is Mark Spellman. Please stay with us. I will note that the vote has started in the House on that potential TikTok sale or ban in the U.S. We're going to continue to follow that. You can see that voting has started. We'll keep a close eye. But let's take a quick look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Bailey Lipschultz. Bailey, what do you have your eye on?
Katie, it's impossible to not talk about, Bitcoin at this point, topping $73,000 for the first time. On Tuesday, according to Bloomberg data, there was more than $1 billion in inflows into those spot ETFs, setting records really across the board, and that's really why you're continuing to see a move up and to the right when you talk to some specialists. The big thing is that there's an insatiable demand right now and not many sellers. So when you have more buyers than sellers, that inherently drives things higher. When you look back at many of the manias I've covered, Katie, meme stocks, some of these crypto one-off assets, a lot of the IPOs that come out, you see sharp moves to either direction because there are low floats of shares, and that's really what you're seeing with Bitcoin continuing to move ever higher, and it really kind of is breathtaking when you look at how it's outperformed and really stripped away from a lot of those bigger technology companies that it traditionally had tracked.
I'm glad you brought up the ETFs. It's my favorite thing to talk about. You take a look at BlackRock's IBIT, for example, taking in nearly $850 million yesterday alone has just been a real pleasure to watch. But let's also talk about a different mania, and that's what's going on in Tesla, taking another leg lower today.
Yeah, moving lower after Wells Fargo downgraded shares to an underperform equivalent. So basically telling clients to sell the stock. I want to call this out. The analyst says Elon Musk company is a, quote, growth company with no growth, calling out the fact that sales volume only rose 3% in the second half of 2023 from the first half, while prices fell 5%. So, Katie, a lot of detractors around Tesla. We've seen the stock drop close to 30% to start 2024. When you come out and see a number of analysts continuing to pound the table for the bearish side, that really does stand out in a market that, for the most part, whether you want to call it the Magnificent Seven or the Fab Five, if you strip out Tesla and another company, it really is showing up in 2024, and that bearish call from Wells Fargo weighing on Tesla shares this morning.
So Tesla shares continuing to fall out of bed, but it looks kind of small when you take a look at what's going on with Dollar Tree.
Yeah, sharp move lower, double-digit move for the company, reporting underwhelming results, underwhelming outlook, announcing that they're going to close more than 600 stores over the coming months and year. 14% drop is really a sharp move lower for investors who have been buying into the rally over the last few weeks and months. The one thing that did stand out when you look at some of the analyst reactions is the fact that the company has a lot of uncertainty around their path to $10 of EPS. That had been something they had been pitching. And Katie, I don't know if you've been to a dollar store recently. The thing that stands out to me is that a lot of these stores don't actually sell things for $1. So when you're looking at the business, it is being kind of questioned, if you will, by a number of these companies. And that's why we're seeing, or a number of investors, that's why you're seeing stocks like Five Below trading lower in sympathy.
Inflation is everywhere. Bloomberg's Bailey Lipschultz, thank you so much. Now coming up, Amazon and Eli Lilly team up to bring weight loss drugs directly to consumers. Details next. This is Bloomberg. Well, some big news out today. Drug maker Eli Lilly teaming up with Amazon to sell weight loss drugs. Zepbound will now be available through Amazon's pharmacy, delivering the GLP-1 drugs right to consumers. Bloomberg's Madison Muller joins me now with the details. And Madison, so this is part of Lilly Direct, correct?
Yeah, so this is part of Lilly Direct, and I spoke with executives at Lilly, and they said that this is just the next phase of expansion as Lilly Direct continues to evolve. We know that it just came out in January, so they're still trying to grow it, and this is the latest phase of that.
And so, I mean, this would theoretically make it easier for consumers to get their hands on some of these drugs. How does that fit in with the supply shortages that we keep hearing about?
Exactly. So that's part of the reason why Lilly started LillyDirect, is because it's just been a hassle to get weight loss drugs for many patients because of the supply shortages. There's so much demand, and then just general issues with the U.S. healthcare system in general. So this latest initiative from Lilly is helping with turnaround times, ideally, and Amazon is also hopefully going to help with that as well, and just helps patients connect directly with doctors and then also have that home delivery of their prescriptions as well, if that's the right option for them.
And before I let you go, what sort of uptake has Lilly seen through the likes of LillyDirect so far? Do we know that?
So we don't have exact numbers yet, but Lilly's CEO, Dave Ricks, did say yesterday in an interview with Bloomberg's Caroline Hyde that already they are seeing extremely successful results, strong uptake, so much so that they're actually having trouble keeping up with the demand for this service.
All right, Madison, great reporting as always. Appreciate your time. That is Bloomberg's Madison Mueller. Now let's keep the conversation going now with Mark Spellman, who remains with us. And before we went to break, of course, we were talking a bit about Google, sort of an underloved AI play. You take a look at its valuation, definitely trading cheap to some of its peers. But along that theme, what other names have been sort of overlooked when it comes to just this AI euphoria that we've been witnessing?
Sure, there's a couple of names. And in industries, when you think about the data center world, it's a major beneficiary from AI. You look at the HVAC world, air conditioning and ventilation, believe it or not, I mean, huge. Trane, increased its backlog by about 25-30% in the end of last year for commercial projects. Read data centers. The runway for Trane's business, now mind you, they do Thermo King and Trane air conditioning, the runway there is multiple years. Now that stock has done very well, and it's about 28 times earnings. I put that on my list of names I want to own. If you don't own it yet, wait for a little bit of a pullback. Where you can, the second derivative below that is Carrier Global, 8 multiple points cheaper than Trane. Trane's outlook is a little better than Carrier's right now, because Carrier has a little bit more residential and it has more Europe. So they're not hitting on all cylinders like Trane is. But from a valuation standpoint, new money, we would say Carrier Global.
Can you walk me through that a little bit more? So I understand it's a second derivative AI play, but how does AI fit in with an HVAC company?
You got to cool those machines when they're in the boxes, and it's massive. And it's not just that one play. Look at a building like the Bloomberg building too. Air quality is a huge deal post-COVID. Nobody wants to come back to work unless they feel safe. The air quality issues have been a huge boon to a company like Trane. Retrofitting new buildings, plus you have new regulations from refrigerants, that's helped them as well.
Okay, so we have the Googles of the world, of course, that can help sort of more directly when it comes to their search business. Then you have the second derivative plays. What about the picks and shovels? I mean, how are you thinking about chips right now, about the likes of NVIDIA? Is that just too hot to handle?
It's again, I would say NVIDIA, great company, want to own it. Own it if you have it, wait if you don't. If you want to get in the more of a value situation, Hewlett-Packard. Here's a name that did tremendously well during COVID. Obviously, work from home was a huge boon to them. Everyone got a new laptop and a new printer and buying lots of ink and stuff like that. And then the growth rates fell off a cliff, as well they should. However, Hewlett could be hitting another cycle. Well, there's two major things happening. AI, they just announced a whole new line of computers with NVIDIA, which is perfect. I mean, that's the best partner you can get. That'll be launched in the second half of this year. In addition to that, Windows 10, if you remember what that is,
I've heard of it.
Exactly, officially dies later this year, and there's a replacement cycle for old PCs there. So we think this is a name with an outlook that the earnings could surprise to the upside 12 to 18 months out. If you get $4 in earnings, you have a name that's 9 times earnings right now, selling at $30. a 3.8% dividend yield and a 10% free cash flow yield. It's retired, I think, 40% of its shares outstanding in the last 5 years. We think that's a real good risk return right now. A name you might not think as an AI play, but definitely a second, maybe third derivative play for AI.
Well, that's what I want to talk about, because clearly you're doing your due diligence. You're finding these second and third derivative plays. But what is the catalyst for the broader investing community to sort of wake up to that narrative? Do you just have to wait for earnings, or what actually will put this into the zeitgeist?
I think that's exactly right. You hit it. It's earnings and cash flow. It sounds like a great story, but Hewlett-Packard's recent results aren't showing any benefit really from AI. However, 12 to 18 months from now, if you get that 9 multiple, if they can show that they're a participant in this AI cycle, that 9 multiple will go dramatically higher, and that's where you'll make a ton of money. And if they can positively surprise on the EPS side and expand their multiple, it'll be a real good stock.
So definitely something to watch there. I want to circle back to what we were talking about, though, when it comes to these smaller and mid-cap sort of names. When you look into the indexes and go under the hood a little bit, where are you seeing the opportunities when it comes to specific companies?
Yeah, it's very one-off. It's less thematic. I think the theme would be broadening out in that magnificent 495 that I discussed. We have a name like IMAX, the theaters. They don't own movie theaters. They license their name. They license their technology. Stock did terrific last year, basically because of Oppenheimer and a bunch of other names. The writer's strike kind of put a kibosh on new movies. Probably won't see a lot of big blockbusters till later this year. The stock has net cash on its balance sheet, has a big business in China, so it is a China play, and the movie going is very good in China. IMAX has also expanded their product offering to a lot of local language stuff, so it doesn't just have to be English speaking blockbusters out there, and they've done a real good job, and they've bought back a lot of their stock too. We think that's an interesting name. Honestly, from an M&A front, I think this could definitely be something, and if that were to the case, $25+ per share is kind of what our target is on a deal.
So definitely something to keep an eye on there. I will note that Dune 2 did come out.
Dune 2 has been a big
deal.
upside surprise, really. It's definitely doing better than they had thought. So the stock has popped a little bit, but I wouldn't worry about that. At 16, 17 bucks, it's still a buy here.
All right, Mark, well, really enjoyed this conversation. Hope to speak with you again soon. I think we covered quite a lot of ground. That is Mark Spellman of Alpine Saxon Woods. Thank you. Now, still ahead, we're going to take a look at the companies that are making the most social buzz today. That's in our Social Climber segment, up next. This is Bloomberg.
Great questions.
right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, we have Volkswagen expecting orders in Europe to pick up speed as it updates popular models. Now, the German car maker's CFO spoke to Bloomberg TV earlier on his outlook.
2024 will be a challenging year. We have macroeconomic environment is uncertain. We have interest rates still high. On inflation on the cost side, and there's a lot of competition in the BEV markets. But there are also positives. The market will grow slightly, and we bring some great new models.
Meanwhile, the company facing a lot of headwinds, including softening demand for EVs and growing competition from cheaper Chinese models. Next up, we have Allbirds. It's gaining traction on social media. The wool footwear company issuing a weaker than expected outlook for revenue, and analysts saying there is limited visibility into improving sales, and the recent departure of its CEO isn't exactly helping confidence all that much. And finally, we have Petco. It's losing its top dog. The pet health and wellness company announcing its CEO will step down. A member of the board will serve as interim CEO until a permanent CEO is found. Also worth noting that the company beat fourth quarter earnings estimates. That's certainly helping shares out this morning. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. You take a look at the broader markets right now. It's pretty quiet out there, quiet to down. You take a look, of course, at the S&P 500, for example. You can see we're down by just a hair, about 0.1% or so, slightly more if you take a look at the likes of big tech. The NASDAQ 100 currently off about 0.7%. Of course, we had a big green day yesterday, so maybe the market's taking a little bit of a breath at this moment. Now coming up, the FTC suit to stop the Kroger-Albertsons deal is set for trial. We're going to speak to Scott Moses, Solomon Partners partner and the head of the proposed Kroger-Albertsons deal next. This is Bloomberg. Well, the FTC has set a trial date in August for the proposed $25 billion merger of supermarket giants Kroger and Albertsons. The FTC, 8 states, and Washington, D.C. have sued, claiming that the merger would lead to lower wages and higher prices for customers. Now, the supermarkets say they need the merger in order to compete. I spoke with SpartanNash CEO Tony Sarsam on the state of grocers on Monday morning.
Independent grocers is our primary customer that we serve, and that's a wholesale customer. So we serve about 2,100 of them overall, 2,150, something like that. And there's about 21,000 of them in the United States. These are folks that operate, typically as family businesses. They operate in an inner city where there otherwise might be a food desert. They operate in the suburbs sometimes, but most commonly they're in small communities across the entire United States. And they're small family-run businesses, and they rely on wholesalers and folks like us to help solve their problems and help think about how they can run their business efficiently. They look to us for the tools, whether IT tools or category management tools or insights we can provide. And of course, they look for us for that overall supply that's consistent and predictable, and the pricing makes sense for them as well. So all of that makes up how we actually manage through that. And so, to your question, the retail and the wholesale is sort of the same thing in a way, right? We're serving them. They run retail stores. We run retail stores. We see the same types of trends, but because of our scale broadly, we can offer what a $10 billion company can find and offer to a two-store family chain is really invaluable to those folks.
Well, before I let you go, I want to talk about one of your key wholesale customers, and that's Amazon. Of course, business from Amazon, it's been slowing as they pursue their own efforts there. How do you make up for that lost business? What does your planning look like right now? So
we're doing the same types of tools that I mentioned a moment ago. We're looking for ways to grow organically in our stores and with our wholesale partners, make sure they have the right offer for their shoppers. And we're also evaluating inorganic opportunities all the time. So we're looking for those ways to continue to grow. And we actually are bullish on Amazon. We believe they're going to come back and grow. And so we want to make sure we're a good partner for them. And when they're ready, then we're going to be ready for them.
And that, of course, was my conversation with SpartanNash CEO Tony Sarsam on Monday. And we have a great conversation coming up, but we do want to bring you some breaking news right now on that TikTok vote. And that is that the House, it has enough votes to pass the divestment bill. And joining us now with more is Bloomberg's Jackie Davlos in Washington. Jackie, what do we know right now?
Well, now we know that this bill moves to the Senate, where it faces a much more unlikely future. Here you had largely bipartisan support for imposing this deadline of 180 days for TikTok's parent owner, ByteDance, to divest and seek either a new buyer for TikTok or face a ban. Now, you have an interesting dynamic going on here. If you look at some of the nays, you have pretty prominent members of the House both coming in opposition. For example, Representative Marjorie Taylor Greene actually sided with former President Donald Trump, who had expressed his own views on opposing the bill earlier this week before it came to a vote. She says that this could actually lead to other similar bans for other apps, something that, is a cause for concern, perhaps some government overreach there. Then you have a Democrat, AOC, Alexandria Ocasio-Cortez, also coming out in opposition, saying that many people depend on this app and that this process was just too rushed. So now you have the House clearly voting to move this forward. Whether or not TikTok's lobbying efforts on Capitol Hill, which have been directed toward the Senate at this point, will be effective is still yet to be seen.
All right, Bloomberg's Jackie Davlos, thank you for that instant reporting there. Of course, on the breaking news that the House has the votes to pass that TikTok divestment bill. Of course, the vote is still ongoing, and we're going to continue following that one. But let's pivot back to the grocery store, and specifically grocery M&A and the proposed merger between Kroger's and Albertsons. And I'm pleased to say that we're joined now by Scott Moses. He is partner at Solomon Partners. He's the head of the Grocery, Pharmacy, and Restaurants Investment Banking Group. And of course, he's also the head of the proposed deal between Kroger and Albertsons. So, Scott, we talk about that deal. I mean, initially proposed back in 2022. It's been a long path to here we are now. How confident are you that this deal will actually close?
Well, I'm very confident because this is not some abstruse industry that we don't understand. We all know the facts here. Our friends, our families, our colleagues, they all shop at Walmart, Target, Costco, Amazon and Whole Foods, Aldi and Trader Joe's and Dollar General. And out west, they shop at a long list of other grocers like Sprouts and Cardenas and 99 Ranch and Grocery Outlet, Winco, and New Seasons. So the FTC is describing a grocery industry that we haven't seen in decades, right? I mean, quite candidly, I think you need a DeLorean, a Huey Lewis cassette, and Marty McFly to take you back in time to the 1980s to shop there. It does not exist in 2024.
Well, that would certainly be fun if that was possible to go back to the 80s. But let's talk about some of the remedies that have been proposed to actually get this over the line. You go back to September of last year, and the two stores, you began talks of selling more than 400 locations throughout the country to C&S. Does the FTC accept those divestitures as a remedy here?
Well, clearly the FTC has, articulated some questions. But the fact is, C&S is a very strong divestiture buyer. And you had Tony Sarsamon from SpartanNash a little while ago talking about how well, as a supplier, their infrastructure serves, their different retailers around the country. The fact is, C&S is 40 or 50 times larger than the Haggen transaction that a lot of folks talk about. C&S is one of the largest grocery suppliers in the U.S. It's the 8th largest private company in the U.S. It's owned by one of the wealthiest families in the U.S., and it's got over 100 years of grocery operating experience, $20-some billion in revenue. It supplies over 7,000 stores with extensive infrastructure across the country. And unlike Haggen, they're going to be acquiring or licensing the banners of the stores that they're buying, which corrects a key mistake. That will help with continuity, and it'll help make sure that they can use their strong balance sheet to invest in price and wages and marketing in ways that Haggen didn't. They've also got a deep management team with extensive acquisition and integration experience. And remember, the FTC validated C&S as a divestiture buyer just 2 years ago in a merger here in New York State between Price Chopper and Tops. And by the way, those stores are doing very well now.
Points taken there. Should we expect more divestitures, of course, from Kroger's and Albertsons as we potentially count down to the closing here?
Well, I can't speak to the negotiations that have been ongoing between the FTC and Council. But what I can say is the grocery industry is radically different than the one that the FTC describes, okay? It's got not just supermarkets, but supercenters and club grocers, discount, dollar and drug grocers, specialty, ethnic, and online grocers. And yes, supermarket grocers as well. Remember, the USDA actually allows SNAP purchases of groceries at all of those different grocers, right? So I think that's a pretty good indicator as to just how broad the grocery industry is today. Remember, supermarkets only comprise some 36% share in grocery today. They're down to 5 of the top 15 grocers. They used to be 10 about 20 years ago. The other 10 of the top 15 are these national discount grocers like Walmart, Target, Costco, and Amazon and Whole Foods. And they've got 64% share, and they are rising fast.
And I do want to just bring us a headline as we continue to follow that TikTok vote. This crossing the terminal right now that the U.S. House passes the bill that would force TikTok sale or face ban, of course, that divestiture from their parent company, ByteDance. We're going to continue to follow that one. Of course, it goes to the Senate now, and we'll see what happens there. But, Scott, I do want to talk about, of course, the heft of Walmart and the likes of Amazon when it comes to grocery. But before we get there, I do want to talk about some of the pushback to this deal. I mean, in addition to the FTC, you also had the United Food and Commercial Workers International Union saying last May that they oppose this merger, that it poses a, quote, serious threat to members' livelihoods. How do you think about those responses? What would this potential merger mean for salaries, et cetera, when it comes to the people that actually work at these stores?
Well, first, I think it's important to say that grocery teammates around the country are incredibly important. Okay, they were the unsung heroes feeding the country during COVID, and they have been in crisis after crisis. So with that said, though, union jobs have precipitously declined at our top grocers around the country as the non-union national discount grocers have grown so much. Conversely, Kroger has added over 100,000 union jobs in the past decade, and they've committed, in addition to lowering prices day one with this transaction, they've also committed that they're going to increase wages by $1 billion. They're going to invest $1.3 billion in better stores, which strengthens those jobs. They've said there'll be no store closures, no frontline job losses, period, full stop. And the transaction was endorsed by Local 555 in Oregon, Washington, Wyoming, and Idaho. They've got 18,000 members, and they clearly articulated something with which I wholeheartedly agree, which is Albertsons is for sale. It's going to be acquired. And they would much prefer that the buyer be, as it'll be here, Kroger and C&S, rather than some non-union or anti-union company like Amazon.
Well, Scott, that's kind of what I wanted to get to. I mean, if this merger doesn't go through, what do you see as the path forward, both for Kroger's and also for Albertsons? What would potentially be the next plan?
Well, look, my focus here is on the facts and the data, okay? And the facts and the data very clearly imply that this transaction is very important to help lower prices for consumers around the country and to help improve wages and stores around the country as well. Now, the irony here is that the real beneficiaries from trying to block this transaction are the enormous non-union national discount grocers like Walmart, Costco, and Amazon, okay? It's almost as if the FTC is putting their thumb on the scale to support them. Now, that may not be the intention, but it's undeniably the result. And if supermarket grocers aren't allowed to level the playing field, it won't be long before grocery looks like department stores, with thousands of supermarkets closed and millions of union jobs lost. That's what we're trying to prevent here. And quite candidly, I've been doing this over 20 years. That's what I've been trying to do my whole career, to help keep supermarket grocers open and vibrant and a part of our communities so they can continue to serve them.
All right, Scott, got to leave it there. Really enjoyed this conversation and appreciate you rolling with the breaking news. That is Scott Moses of Solomon Partners. Let's get a check on the broader markets right now. We're going to do that with Bloomberg's Abigail Doolittle.
Well, relative to big tech, Katie, it's not so positive. You can see here the NASDAQ 100 down about 0.7%. In fact, over the last 4 days, down more than 1%. A lot of this having to do, at least today, with NVIDIA down, the last time I looked, 3.5%. Some chips being taken off the table from that big rally. Relative to some of the other indexes, it's a little bit more mixed. The S&P 500 may still be down ever so slightly, down about 0.1%. You can see the stocks, though, in sympathy with NVIDIA trading off down 2%. On the other hand, small caps up 0.6%. And take a look at the Golden Dragon China Index, that China Tech Index, up 2.2%, up for a fourth day in a row. In fact, up almost 5%, or excuse me, 8% over the last 4 days. A technically driven rally with that index going right above its 50, 100, and 200-day moving averages. Let's see whether or not it can hold. Relative to the S&P 500's technicals, this point cannot be overemphasized, or at least that's my feeling on it. We've been looking at this chart for quite some time, and it's continued to grow. This is the S&P 500 over the last year, so you can see this nice uptrend. But what is happening is as the index makes more and more highs, record highs, the RSI is not gaining ground. In fact, right now we have this RSI at a 65. So the recent record high at a much lower level than what it was last December. That basically tells you that there's less momentum, less enthusiasm on the part of the buyers. Maybe even you could say weak hands buying from those who bought well back here. Relative to some of the movers beneath the surface, well, let's take a look at Williams-Sonoma, up 18.8%. They boosted their dividends and buybacks. It was also a solid quarter, very nice day there. I think that there's a decent short interest. Alphabet up 1.2%, and some of it having to do with their AI chat box. And then Tesla down 3.8% over the last year. This is hard to believe. Now down over the last year. This, of course, is Wells Fargo is making the call. How can you have a growth stock with no growth? Downgrading it to the equivalent of a sell. And then Dollar Tree's down 14.4%. The 1Q earnings guide, Katie, not great. They're also closing $600 general stores, 1,000 stores overall. The CEO saying that for the lower income shopper, that there's more deliberation, that they're less certain.
Yeah, quite a wipeout we're seeing today in Dollar Tree. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, investment opportunities in India. We'll have highlights of our interview with Henry McVeigh, KKR Head of Global Macro, Balance Sheet, and Risk up next. This is Bloomberg. All right, it's time now for Wall Street Week. And earlier, Bloomberg's David Weston sat down with Henry McVeigh, KKR head of global macro, balance sheet, and risk, and asked him about his recent trip to India and what improvements he's seen since his last visit to the country over a decade ago.
When I first joined KKR in 2011-12, we wrote a piece and we said, this is what India needs to do to hit its potential. One of them was invest in infrastructure. The second was reduce its deficits. It had twin deficits. And the third was stop subsidizing everything and let the real economy do its thing. And I was just back in there recently, and you can see from our piece, I mean, they have done those. I mean, a lot of credit to Modi. He's done an excellent job. But when you look at it right now, massive investment in infrastructure, particularly around roads, which is critical to that economy. Second is around data and making sure that you can actually have the technology do what it's supposed to do as it relates to the internet. And then finally, I think about all the stuff around the rule of law and making a better bankruptcy court. That's something where foreign capital now wants to be in India, and it's more active. And so it's a pretty good environment right now. As you mentioned, a lot of people are thinking, where can I get emerging markets growth? And what you see is while I'm talking about this latest update, India's public equity markets have been outperforming by about 700 basis points for the last 10 years. So this story, it's a growing one, it's getting better, but it's not a new one.
So those reforms you talk about, how do they manifest themselves in economic numbers? For example, growth. And by the way, we've always been concerned about inflation in India.
Yeah, so there are a couple of things. One is real GDP has gone up since the past couple of years. There's more consumption in the economy. I think you're seeing the rise of the middle class, particularly the middle to slightly higher class. They're really starting to spend, and they're enjoying the benefits of that. The second is everybody now has a digital bank account, and so the government can be much more targeted in terms of doing fiscal subsidies, making sure that money is being transferred properly. And then the final thing is, unlike China or the United States, India has really created a technology platform that is agnostic. So their version of Amazon or the search engines is actually just to have something that's open to everybody, not having one private sector company control that. And over time, that could be a differentiated model. It's still early days, but those would be a couple of big changes we're seeing.
So let's unpack a couple of those. One is personal consumption. There's a lot of talk about China and the fact that they're trying to get a more consumer-driven economy.
Yeah.
Haven't necessarily succeeded thus far. What progress is India making, and how is it making that progress? What are they doing?
So the good thing is they don't have to start by increasing from exports to consumption. The economy is almost, I think, 65 to 70% consumption to start off with. So it's really about increasing GDP per capita. That's why it's so important they keep inflation down, because you need to see real GDP per capita go up, which is tough in an economy that often has inflation. The second thing is they've done things around taxation to make sure there's something called the GST tax, where it's made it more efficient. So you actually have the ability to transport goods across different regions within India. In the past, you've had waste, and it's taken time, and the toll on actually getting the goods from one area to the other has been much worse. So that's improving. And then the final thing we're just seeing is there's more confidence in the consumer. We have exposure to different types of financial services companies in India, and actually the loss rates are down. So there's a confidence where people, they want to invest in their businesses, they're actually paying off their debts, and the consumer is spending a little bit more. If you contrast that with a country like China, is less than 40% consumption, the savings rate is way up, and they really had made their growth through fixed investment. So you need all the different food groups. You need fixed investment, you need exports, you need consumption, but what makes India unique relative to some other emerging markets is they don't have to export their way out. And in a world where we've got a lot of volatility, we've got some unnatural acts around geopolitics, having a strong consumption base, be 2/3 or more of your economy, is actually a winning formula.
So give us a peek at your playbook, if you would, at KKR. I mean, you went over there to look at it as an investment opportunity. For investors watching this, where do you see the investment opportunities?
I think there continues to be. India has a wonderful set of large conglomerates that are going to grow both in India as well as in around the world. They also, I think they've done a lot around technology, retail, telecommunications. We've been partnering with some of the larger companies in India to really bring foreign capital and some expertise expertise around industries. That's been a great relationship for us. So that's one big area. You can play that through public markets or private markets. That's through our private equity at KKR. The other area that's really growing fast right now is around infrastructure. The government is looking to move $4 to $5 billion out of the public into the private hands per year. Toll roads, transmission of energy, data, all that area, that is booming. And India is more known for the public equity markets, but there's a huge amount going on in infrastructure, and the government really is supporting that privatization, and it's going to, I think, make a difference in the efficiency of the economy. And then the third one is around credit. What you're seeing there is more of a credit society. I think that's something where you need to make sure you're partnering with the right companies to lend, but those are really the big groups where we've been focused. And then obviously real estate remains a big area of focus within that economy. Particularly, they had a housing kind of bust and too much credit in 2018 and 19, right before the pandemic, and I spent a lot of time there during that and kind of watching that downturn. What you're seeing right now is actually that real estate sector do very, very well, and that's gonna draw investment too.
And that was KKR's Henry McVey sitting down with Wall Street Week host David Weston. This is Bloomberg. All right, we do want to revisit some breaking news over the past hour, and that is the U.S. House passing a bill that would force TikTok sale or ban it altogether. Of course, it is the most serious challenge yet to a service that's used by 170 million Americans. This measure passed Wednesday by a vote of 352 to 65. Of course, it goes to the Senate now, where it has a much less certain future, though. President Joe Biden, he has said he'd sign this legislation, even though his campaign recently joined TikTok. Now coming up, T. Klein, Edge and Node CEO. She joins BTech next. This is Bloomberg.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we will have full coverage on TikTok throughout this program. The U.S. House, it passes a bill to force ByteDance to sell TikTok or face a ban in the U.S.
Plus, the European Union passes the world's most extensive AI guardrails. We'll break down the impact of the AI Act and what it means for the future of artificial intelligence.
And Chamath Palihapitiya's Social Capital, it fires 2 partners after a probe citing an undisclosed situation. We'll discuss what could be behind the decision that involves a much-hyped AI startup. But first, check in on these publicly traded markets. After yesterday, yet more records to be had. Today, we just ease back a little bit. No major macroeconomic data on the table, and instead we just digest where indeed the Federal Reserve might go, what the inflationary pressures are. We're off by about 0.6%, maybe a bit of profit taking being had. I mean, Stock 600 actually managing to fight off some of the doom and gloom scenarios happening in the US at the moment, and we're in fact up 0.2%. Not big, but some key AI fervor still happening over across the Atlantic. 30-year yield pushes higher. Maybe this what dictates trade here in the United States. Quiet in equities, but we see the bond market 30-year auction. There was pretty lackluster demand yesterday. Will we see this take up? We see yields just push up about 3 basis points. Moving on from that into the world where, well, we just don't catch a break in terms of the run-up. Bitcoin once again powering up 2 percentage points on the day. We're in eclipsing that 72,000 at one point. $73,000 handle is where we were on Bitcoin. But Ed, what are you watching on the micro?
Social media names. These are Rumble, Meta, Snap, and Alphabet, parent of Google, which of course owns YouTube, over the last 7 days. But the moment that the House did pass the divest or ban TikTok bill, there was a significant leg higher in both Rumble and Meta. But I put those up because the conversation will now change, right? We're going to discuss whether